Sell-off continues on the street with the Nifty decisively below the 23,400 mark, on track to close the week almost 2% lower. Broader indices see deeper cuts of over 2% today, with all sectors in the negative territory. VIX stays elevated. The rupee has hit a fresh record low of 92.48 per dollar, pressured by surging crude prices, foreign investor outflows and a stronger dollar. The slide comes as tensions around the Strait of Hormuz keep oil above the $100 a barrel mark. The US Navy plans to escort oil tankers through the Strait of Hormuz once feasible, even as the country has issued a temporary waiver allowing purchases of Russian oil already at sea. Meanwhile, Iran's new leader insists the Hormuz choke point should remain closed, keeping energy markets on edge. The government is moving to secure fertilizer supplies ahead of Kharif season, with officials reaching out to China to ease restrictions on urea exports. According to sources, India currently has fertilizer reserves of around 17.7 million tons. Kalpataru surging after the company signed a redevelopment deal in the suburbs of Mumbai. The residential project has a potential development value of around 0.4 million square feet, with an estimated gross development value of around 1,400 crore. Well, pain is pronounced. We're below the 23,150 mark, in fact, at this point, testing levels of 23K, 500 points lower, 2% down on the Nifty 50 index. When you're seeing that tilt of the index, well, there's just no green whatsoever in terms of stocks. There's just Tata Consumer, which is clinging on to green, 1.3% lower. HUL is up. Tata Consumer is 1.3% higher. HUL is up around 0.7% and Bharti Airtel also clinging to the green with the skin of its teeth. So that's broadly the tilt. When you're looking at the 47 stocks in the decline, L&T leads the pack, 7% lower. Hindalco down 6%, Tata Steel down 5%, Tata Motors down nearly 5%, JSW Steel down 4%, Ultratech Cement down 4%, BEL down 4%. Wow, I mean, the list just goes on. There's just so much pain across the board. Let's talk about auto counters. Bajaj Auto, M&M, Aisha, Maruti, all of those are down 3 to 4%. But let me first take it across. We have the finance minister speaking.
Imposed kind of a restriction so that we don't have a habit of bringing in more and more amendments and seeking Parliament's approval. We have made sure that we will minimize it to 2. But not doing even 2 or 1 would mean that we are inflexible, and would also mean that where states are asking for some, or when departments are asking for something which is so essential for them to function, it will look very uncaring and irresponsive of the government. And therefore, I think supplementary budget, which as per the original constitution makers, supplementary demand for grants is a very useful instrument. And where it is necessary, we will have to use it. But bringing that supplementary demand for grants should not be looked at as if some wrong assessments have been made originally in the budgetary estimate time, and therefore we have brought this. So it is done with a lot more open-mindedness and also flexibility which can be offered to the departments. And in that order, this time, we have placed the second supplementary demand for grants. Sir, in this, I seek the approval of the Parliament for expenditure requirements related to 61 grants. This involves gross expenditure of about 2.81 lakh crore through cash or technical or token supplementaries. The present proposal also includes an amount of 902 crore rupees that is being provided for recouping advances of an equivalent amount from the contingency fund of India. So 2.01 lakh crore is the cash supplementary which is being taken under 18 grants, while 0.8 1.80 lakh crore is the technical supplementary, and that's being sought for 32 grants, and 59 total supplementary items are being sought from 43 grams. Upfront, I like to say that this 18 plus 32 plus 43 may not add up to 61, which I originally said 61 grants are being placed here, is because some of them repeat or overlap, so the numbers may not add up. With respect, I would want members to be taking this fact into cognizance. Now, first of all here, I also would want to give that point as a reiteration. I wish to reiterate that with all this extra that we are coming up with, technical supplementary, cash supplementary, I do not want any member of the parliament to wonder if I will be able to reach the fiscal deficit number that I have said during placing the budget here. The budget for 26-27 certainly states what's the budget fiscal deficit for the year ending March 31st, 2026 is going to be, and the rest is going to be for the rest. So we are not going to, in any way, not fulfill the word given in the budget. So I wish to reiterate that the commitment which has been given in this House for the second supplementary, inclusive of the second supplementary demand for.
All right, Karan standing by. That's of course the finance minister, but we have Karan standing by with regard to the stocks which you want to keep on your radar for this afternoon based on all of the announcements and everything that's playing out on the street. Karan here with that list. Karan.
Well, starting off with Acme Solar in the renewable space, the company has commissioned 481 megawatt hour battery energy storage system in Rajasthan. Remember, earlier the management had upgraded its battery energy storage system operational guidance, expecting 2 gigawatt hour instead of 1 gigawatt hour to become operational in FY26. On that note, the company is targeting 10 gigawatt of operational capacity by 2030. So do watch out for that. Next, we have NTPC Green. The management has said to ET now that the BSS project will start in FY27. Thereafter, the revenue realization from the BSS project will take 15 to 18 months from the time of operationalization. Currently, the company stands at a 9.5 gigawatt capacity. And this year till date, the company has commissioned 3.6 gigawatt of capacity. On that note, the total pipeline of 30 gigawatt capacity generation is expected to be achieved by 2029. Next, we have Ramki Infrastructure. The company has entered into a concession agreement with MIDC for a project in Raigad. The total project cost is estimated to be around 3,000 crores, with additional revenue streams opening up for the company in the form of land lease premium, development charges, and maintenance income for the services. And finally, we have Manorama Industries. The board has approved a 500 crore fundraise via a QIP on 12th of March to fuel expansion. And on that note, the firm is expanding capacity by 30% to 52,000 metric tons per annum. So do watch out for that as well.
Okay, thank you so much for that, Karan. Let me take it across to Kunal Bothra joining us this afternoon. Kunal, critical day, 2% lower on the index. I mean, this is looking very difficult as a day. What should a trader do? What should one look at? And how are you looking at the downsides here? We're now really in a steep fall.
Yeah, absolutely, Harsh. I think the day seems to be getting a little worse by the hour or by the minute. We have seen a sharp sell-off. We've broken below the crucial supports. 23,500 was the pivot for the index. We've broken below that as well. It looks like that. I think we are looking at a point where the bank Nifty is getting a lot more weaker. The market breadth has fallen down today. So it looks like that maybe I think the start of the next week, this kind of a market mood could probably continue. You've seen crude oil prices coming back to 102, 102 and a half, the last I saw. So I think on the back of this, you're looking at the market showing signs of weakness further.
Levels we are open for, Kunal?
So I believe we are now looking at a potential break of even 23,000, which could be possible start of the next week. On the downside, I think if it happens, then we are looking at 22,800 as a first support.
22,800 as the first support. Oh, it's looking increasingly bleak. So another 10% another percent or two likely from here is what you're really penciling in as early as next week. Your picks in a market like this, Kunal, what should one do?
See, it's very difficult to try and categorize picks in this kind of a market, frankly, Harsh. So I'll go with the stocks which I've been recommending earlier. Paytm is something which I've been recommending on the short side. So that stock continues to look weak. At current levels of 975, would look out for fresh targets of 950 for Paytm. Stop loss could be kept at 995. And the second would be a sell on Bajaj Finance. The stock continues to disappoint, now trading closer to that 850 mark. So on the sell side, would recommend a further target on the downside of 830. Stop loss could be kept at 868.
Okay, so those are your picks, and what we'll do is slip into a very short break. We'll continue coverage on the other side of that break. Stay with us. Let me go across to Meryl. She's standing by with a list of stocks that are moving in trade. Meryl, what do you have on your list?
Well, yes, in stocks buzzing in trade this afternoon, we've got, first of all, shares of IFCI, which were up almost 10% intraday today, driven by the optimism surrounding the NSE's upcoming IPO. Now, how are these related? You must be wondering. Well, the company holds a 53% stake in Stock Holding Corporation, which in turn owns around 4.4% in the NSE. So any progress on the NSE's upcoming IPO tends to boost sentiments around IFCI. Moving on, Dixon Technologies has indicated that their FY26 shipment guidance could see a slight miss, and this is coming as demand remains somewhat weak, particularly due to the increasing prices of RAM globally, which are impacting the electronic supply chain. Now, in the FMCG space, Zydus Wellness is seen insurmountable trading activity, with volumes up more than 150 times of its 20-day averages. Meanwhile, PG Electroplast is also in focus today after questions have emerged around its FY26 guidance. Well, the company actually reiterated their outlook target revenue of around 5,700 crores minimum, which is about around 2,130 rupees less than its 9-month revenue. So that is the number that it will have to be doing in the fourth quarter in order to meet this guidance, which is seeming very difficult for this company. And that is why the shares of PG Electroplast have taken quite a beating in today's trade.
Thank you so much for that, Meryl. It's not just PG. In fact, we've seen a whole host of counters really taking a beating in trade today. Let me bring on board Deepak Gupta, Head of Research and Senior Fund Manager, Equity at JM Financial Asset Management. Deepak, critical day to have you. 2% lower on the Nifty, and you're seeing some real pain all of a sudden. If viewers or investors were to feel that the pain was behind them, today the pain is even more pronounced. What should one do in a market like this? Should you wait, or should you not catch a falling knife, or is this the opportunity to buy?
Firstly, thank you for having me on the channel.
Great.
In our view, currently the market is going through a risk-off environment where globally all the risky asset class are declining in a meaningful manner. India is not an exception to that, and we've seen something similar play out in 2022 when the Ukraine-Russia war commenced. And typically, if one would have held the nerves and would have bought during Feb to June 2022, they were handsomely rewarded post that. So we do think that while the correction is severe and the entire world is facing the brunt of it, at some point of time this event will pass, and in hindsight this could look like an opportunity where one should have added the allocation towards equities, and which is what we advise our clients, that they should hold on to their nerves and continue with their SIPs and keep looking to add at lower levels. and keep averaging out their cost, which will eventually help them in a medium to long term basis.
Point taken, Deepak. What should you add at this point today?
So presently, we're quite optimistic on the healthcare sector, especially on the domestic pharmaceutical segment, given the fact that there is a meaningful opportunity being launched in the next fortnight, where the GLP-1 drug will go off patent, and there are various ways to play that event, and that can be a meaningful contributor to earnings for a lot of pharmaceutical companies in the coming quarters. Apart from that, even healthcare segments such as hospital diagnostics are meaningful opportunities where the demand is extremely robust, and they have been able to demonstrate strong earnings growth along with reasonable top line growth as well.
Okay. So hospitals, healthcare, pharma is where your tilt is. What is it that so I mean, Deepak, in a market like this, there'll be a lot of investors who would have probably be 95% invested in equities. Of course, you stay the course, right? But these are also opportunities to reallocate from pockets or places which were, for example, overvalued or still continue to be overvalued to those which are relatively looking very, very cheap. I'll give you an example. A simple HDFC Bank has moved down 20%. So just simple ideas where you could probably start looking at upsides. But I'm trying to first understand what are the pockets that you sell in a market like this if you are nearly fully invested.
So typically, in a market like this where one is fully invested, one should look to reallocate their funds from the high beta segment towards the low beta segment to make the portfolio more defensive. And hence, segments which are directly impacted by the events which are unfolding, such as increase in crude oil prices, dependent on LPG gas, where we are facing severe shortage currently as a country, because these segments will take some time to recover. While looking at the second order and the third order impact of the event that has played out, and look to add in segments where it's still far-fetched. For example, financials, which have taken a major amount of beating in the last couple of weeks, largely on account of the fact that there is view that there could be higher duress in the MSME segment, which could lead to increased delinquencies in the asset quality. That is a bit far-fetched currently because one doesn't know till how long crude oil prices will remain elevated. But financial is one segment where one could look to increase the allocation, given that the segment has got meaningfully hit by underperformance in the last fortnight.
Okay, so tilt towards financials. Deepak, I wonder how you look at some of the other pockets. Defense, for example. I mean, war is always good for defense, but clearly defense counters have also come under pressure. Just my guess is it's a sentimental knock. Do you go out and buy on dips some of these names? And if so, do you have maybe a tilt to or a preference? Larger PSUs, I know you can't talk names, but maybe larger PSUs, is that your tilt? Are some of the smaller names your tilt, faster growth, etc.?
See, again, as defense as a segment should be present in one's portfolio, and one should be a bit overweight on that segment, given the fact that over the last 4 years, we've seen multiple skirmishes and wars taking place across the globe, and typically the segment will benefit out of the events which are unfolding at present. In terms of allocation towards names, one should look for where the earnings are more stable and resilient, and not really dependent on any specific event per se, irrespective of what their market cap bias would be, and companies where the leverage is reasonably limited and is able to generate meaningful free cash flow. I think those are the kind of defense companies one should look to add in their portfolio. And as you rightly said, there has been a sentimental knock on many of these companies currently, and that could be an opportunity for one to add their positions into these names.
Okay. Deepak, I wonder with regard to consumer, how are you playing that theme? It may already be part of your portfolio. It may be something which looks even more attractive now. Give us a sense of how you're playing it.
Sure. So in terms of consumer, our bias is more towards the high-end segment of the consumer discretionary, which is less impacted by what is currently going on in the market. Also, one should be conscious about the fact that higher crude oil prices implies higher packaging, logistics, and transportation costs. So therefore, there could be some impact on the margins for many of the consumer staple companies. And anyway, these companies are trading at are trading at high multiples, and they're not able to demonstrate strong earnings growth. So that's a segment where we are not very optimistic on. We are more optimistic on the consumer discretionary segment, where there are premium products being available. And as we have seen in the past 5 years, that India is tilting towards the high-end segment of consumption, where the high-end products do better than the mass products. Hence, I think companies which are catering to the high-end consumption segment, those are the segment of companies where we are focusing on.
Interesting. How do you look at new age tech and the like? Because what we're seeing is for example, Eternal, Swiggy, seeing significant corrections there. I'm trying to understand whether you're finding it as a really compelling buy at this point.
Sure. See, for new age companies, we have a very simple yardstick that whether it's new age or old age, the company should have sights towards profitability. The company should be able to demonstrate that they are profitable in the near-term future. And companies which are lesser impacted with the advent of genetic AI, those are companies where we would be more biased towards because of what is happening on the AI side. A lot of things which are taken right now for granted may not, their business model may not be operating in a similar manner once AI becomes a more common feature in their product offerings. Hence, one has to be slightly mindful when one is taking allocation in many of these new age companies, though they may have meaningfully corrected from their peaks. Still, if they are not able to show that they can be consistently profitable, one should be mindful about holding a meaningful position in them.
Okay, Deepak, thank you so much. Critical day. You've come in and given us your perspective with regard to what to do. Be calm, be patient. Don't get into or sucked by the fact that the market has fallen. Thank you for coming in and speaking with us.
Thank you so much for having me. Appreciate it.
All right, what we'll do is we'll slip into another very short break, and thereafter it's going to be an action-packed hour because now we've seen a significant correction and the bears have really taken grip. How does the last hour play out and how does next week really start off? Is this really the dip everyone was waiting for? We'll speak about that and more on the other side. Stay with us. Welcome back, and one stock in focus is Bandhan Bank, and the promoter of Bandhan Bank, Bandhan Financial Services, is exploring exit options for early investors, including the likes of a GIC, IFC, according to reports. The company has hired an investment banker to evaluate stake sale routes. Mithali joins in with all of the details on this one.
Right, so according to ET reports, Bandhan Financial Services, which is the parent of Bandhan Bank, they are exploring some exit options for the early investors, the long-term investors and early backers such as Singapore Sovereign Fund GIC and also International Finance Corporation are considering divesting their stakes. Now, to evaluate the possible route, company has also appointed an investment banker according to the reports. Among the options being explored, one is the private equity stake sale and another one is the IPO-linked liquidity event. The board of Bandhan Financial Services has also set up a timeline for completing this private stake sale. If a transaction does not materialize by then, the company may shift its focus entirely to liquidate via the IPO event. Now, the move is primarily aimed at providing liquidity to early minority shareholders and could lead to a reshaping of shareholder structure within the promoter's entity. The process is also aligned with the regulatory requirements that mandate a gradual reduction in the promoter stake in Bandhan Bank to 26% by 2030. The development comes at a time when Bandhan Bank's performance has been improving. Now, also, as per the latest shareholding pattern, the Bandhan Financial Services Company, the Financial Inclusion Trust holds 40.7% stake in the company, while Caladium Investment, GIC's investment arm, it holds around 16.7%, and International Finance Corporation holds around 13.6% stake in the company. On the financial front, if you see, company has reported a profit after tax of 285 crore rupees for the first 9 months of FY26 as compared to 104 crores in FY25. Back to you.
Right, okay, that's the update coming in on Bandhan Financials. Mithali, thanks for that update. Just looking at the market construct, over a 400-point fall. Look at L&T, a 6.6% of a fall. And metals is one pocket which is really getting beaten down. So be it a Nalco, a Hindalco, Jindal Steel, JSW Steel, Tata Steel, that entire pack is really getting crunched. But Kunal, do you sense any bottoming out over here on L&T or any of the metal counters?
See, frankly, the indicators are very oversold for many of the stocks. And in fact, what we've seen is that RSIs for these stocks have come into single digits, whether it's L&T or whether it's Indian retails, even for the large cap private sector banking names. So the indicators are deeply oversold in that aspect. But it's just that with even a marginal dip on the indicators, the price correction has been severe. So that's where it's very difficult to preempt that when would these stocks start to show signs of bottoming out. So price wise, maybe I think you might probably wait for another couple of days for the stocks to try and show signs of bottoming out. Indicator wise, yes, I would believe that these stocks have come back into deep oversold territories. The last time I think we've seen such kind of a single RSI, single digit RSIs for stock prices was either in 2025 start in the month of February or March, when the Nifty had fallen down very sharply, or even to years which goes by from 2020 onwards, where the markets were deeply oversold.
Right. Okay, that's the take coming in right now on some of these stocks and clearly getting oversold. Look at what's happening with some of the EMS plays as well. Amber is now down 6%. You've got Canes, which has slid about almost 6%. And maybe, the consumer goods, B2B, B2C businesses, they as well would be coming a little bit under pressure. The only hiding space, if you will, are some of the select pharma names or pharma allied spaces, so to speak. And other than that, of course, there's FMCG, Tata Consumer, Hindustan Unilever. To some degree, Bharti is also resilient, although one must add that Bharti too has gone through its fair share of price damage, but that stock is managing to at least withhold right now. Even Reliance has turned corner and now it's slipped into the red, much unlike where it started off the day with. It's down about 0.6%. Private banks, them also down. IT as well getting under pressure. And then SBI has seen incessant amount of pressure as well, down another 2.25% in today's trading session. 1064 is where SBI is on the futures, and 1058 on the cash markets as we speak right now. But one of the stock which has been in focus has been Kalpataru, and much defying the market trend. This stock has been rallying after bagging a redevelopment project in Mumbai with an estimated gross development value or GDV of about 1,400 crore rupees. Rabinda is here to tell us more about the same.
Well, yes, Kalpataru Limited is in focus, where company has signed a redevelopment project in Andheri West in Mumbai, and the project has a total potential development of around 0.4 million square feet with an estimated GDV of rupees approximately 1,400 crore. And the project is strategically important as it will strengthen Kalpataru's development pipeline and align with the company's focus on the redevelopment opportunities in the MMR regions. And the project will be a fully residential project with home designs for the modern lifestyle, sustainability, etc. etc. And in terms of the company's portfolio segmentation by the development model, own project accounts for around 70%, and JD and JV project account for 27%, and redevelopment project account for 3%. And the company has also guided that it has an upcoming redevelopment project in Andheri with a GDV of rupees approximately 1075 crore. And Kalpataru is increasingly focusing on JV and redevelopment models as these are the capital light with higher margins, targeting IRR of more than 25%. And if we talk about the company's FY26 guidance, then in pre-sales company has given a guidance of rupees 7,000 crore, and company has already achieved more than 3,447 crore in the 9 months of FY26. And on the collection front, they have given a guidance of rupees 5,700 crore, out of which company has achieved 3,409 crore in the 9 months of FY26. So back of this redevelopment project, Kalpataru Limited is in focus, and the stock was up more than 9% on an intraday basis.
Yeah, there's been a bit of a cool-off thereafter. Thank you so much, Ravinder, for that. We'll slip into a very short break. On the other side, we'll take calls from Kunal with regard to Kalpataru. The other one that's flying in trade is Zydus Life Sciences. We'll take his view with regard to that one as well.
Back with closing trades right here on ET Now, monitoring the closing trades, and it's important to take a look at what's happening around the world as well. While world markets and especially Asia definitely got a lot more worse than where it started off trading. Look at Hong Kong, for instance, or for that matter, Shanghai. They weren't as down and out as they closed the session with. In fact, it was a 250-point cut coming in for Hong Kong. Shanghai as well was lower by about 1%. And then, of course, Japan was down over 600 points. What about Europe? Let's check in on those markets too. They're a lot better. Of course, we're talking about a different size of a market here, but 0.5% across the board is the kind of cut that those markets are sitting on. Having said that, there's a marked recovery that you're seeing across the US futures. Early days yet, but regardless, they're definitely flat ahead of the key inflation data that they're anticipating today. And of course, traders continue to monitor what's happening with the Iran war and what's happening on oil prices. We've completely flattened out and recovered all of the earlier losses on the Dow futures, the S&P futures, as well as the Nasdaq futures, which are now lower only by 30 points. The Dow futures absolutely flat, just about a 16-point downtick is what you're seeing on those prices as well. Having said that, in context, our markets have definitely been weak. We're not really taking any heed from the US futures recovery for sure, for 40 points lower still as we speak right now. L&T is now headed in for a 7% decline. Metals weighing heavy on the markets, and autos once again are seeing continual pressure, as was the case even a day before, or in fact all through this week pretty much. But the ongoing gas and LPG shortage in the domestic market, that's definitely been catching headlines, and it's beginning to now impact multiple sectors across the economy. Restaurants and quick service chains are among the most immediately affected, as they rely on commercial LPG cylinders for kitchen operations. Now, this could also have a second-order impact on food delivery platforms like a Swiggy as well as a Zomato if restaurants struggle to meet demand. What beyond food services? Mithali is here with that analysis.
Hi, so hot food, it is disappearing from the menus across India. So from restaurants to roadside kitchens, many outlets are replacing the cooked food, including tea, with fast food and also lemon water, as a nationwide LPG shortage is about to bite, triggered by escalating tensions in the Middle East. And the impact is now spreading across multiple sectors across the Indian economy. First, talking about the QSRs and restaurants. So companies like Restaurants Brand Asia and also the specialty restaurants and quick service chains, including Sapphire Foods, Devyani International, Jubilant Foodworks, all these, they depend heavily on the commercial LPG, which means higher cost and also possible operational disruptions coming in for these companies. Talking about the food delivery platforms like Swiggy and Eternal, they could also see a second-order impact if restaurants, they struggle to cater to the demand. Breaking it down to the glass companies and the ceramics companies, so glass maker Borosil and also the manufacturers such as Somani Ceramics, Kajaria Ceramics, Sera Sanitary Ware, gas forms significant part of the total cost, making them highly sensitive to the fuel price hikes. Then come the beverages and the FMCG sector. For companies like United Spirits, United Breweries, Radico Khaitan, Varun Beverages, where glass accounts for nearly 40% of their total input cost, which means rising gas prices could actually pump up their packaging costs. Talking about the FMCG, so at the same time, the diversion of LPG derivatives could increase the plastic cost, impacting the FMCG majors like Britannia, HUL and also Colgate. Higher gas prices are also hitting the wood laminates and textiles, and companies like Century Plywood, Green Lamb, Vardhaman Textiles, Gokuldas Exports and Arvind Fashion, all these companies rely heavily on gas for completing their whole production process. And the impact, it extends further to the fertilizers and chemical companies as they depend on natural gas and also LPG derivatives as key feedstock. So, concluding all of this, from food to fertilizers, glass to garments, LPG squeeze could actually soon trigger into higher prices across economy unless the global supply conditions stabilize.
Right, okay, that's the fuel crunch impact, and now you're seeing it getting impacted and how it's getting impacted across sectors as well. Let's take a very quick break on that note. We'll be back with more.
All right, welcome back. And that time of the show where we go across to Sajid, who gives us an update with regard to the FNO snapshot at this hour. Sajid, what is it that you're seeing?
Yeah, thanks Harsh. You're seeing some weakness coming into the market towards the last half an hour of trade, where the Nifty is trading below 23,200. So starting off with the mutual futures for Nifty is down nearly 2% in market today, and the open interest is up nearly 11%. Look at the open interest which has got added in the last 1 hour of trade. 11% increase in open interest for the Nifty there. Nifty Bank is another stock, another index where we are seeing the index down nearly 2.2%. And open interest addition of 8% there. In the Nifty Bank snapshot, you will see some of the big private sector banks, having a short position build up, which is coming in the Nifty Bank snapshot there. So that's one thing which is important to look at. HDFC Bank, where the stock is down 1.8. There's a short build up happening in almost all constituents of Nifty Bank, whether it's the private sector bank or the public sector bank, and the index is down over 1,200 points in today's trade. Let's go into what's happening the Nifty options side, and that's an interesting one which is coming in. You have 23,200 where the call writing has increased suddenly in the last half an hour of trade, and that's going to be some indicator of where the pressure is coming in for the Nifty as well. You have unwinding happening at 23,500, 600 and 23,700. So the longer tenor strike prices are getting unwound for the puts there, but there's a good amount of writing happening in 23,500, which is also acting as a good resistance for the index. If you look at the overall, we're seeing 23,000 increasingly becoming a support level for the Nifty. In 23,200, again, there's a put writing is aggressive there. So, you're going to see some kind of reversal towards the last half an hour of trade or so. But unless call writers are going to increase the position, then they push the index down below 23,200. In fact, if you look at next week's options, you can see 22,700 is also one of the most active calls coming, puts coming in for the market there. So there is a put writing now happening below 23,000 as well, as investors are moving and taking more protection at a lower level. Futures gainers, you have Syngene International up 4%, Tata Consumer and Muthoot Finance are the other ones which are up nearly 2% in today's trade. In futures losers, you have L&T. Now this stock is on nearly 8% there. Amber International International is down 6.8% and Jindal Steel is down 6.6%. Among the open interest gainers, you have L&T, where we've seen the open interest up nearly 13.6%. It's nearly 10,000 contracts which got added in L&T. There's a short build-up happening across the board in Phoenix Mills and Polycab as we speak. Open interest losers include stocks like PFC, Nuama, Loda, Oil India, and it's a very brisk trading which is happening, and you can see the stocks moving around there. But PFC, we have seen the open interest down nearly 5%. Let's look at individual stock option. What's happening? Reliance 1400 March call. It's seeing a lot of activity. It's one of the most traded call strikes today. Stock below 1400, you're seeing 1400 build up on call, giving a good resistance going forward for Reliance there. 15.87 lakh contracts got added in Reliance. NTPC is another one where we are seeing some activity in call. The premium is down nearly 1.3 rupees, but look at the open interest position. 40 lakh contracts got added in open interest position in NTPC. Look at some of the puts actually. SGFC Bank 820 March put. It's seen some unwinding of long positions coming in there. Actually 14,000 odd contracts have been closed out, and the premium is up nearly 6.6 for SGFC Bank. Among other stocks, you have PG Electro. That stock is under pressure in the cash market as well. You have 5.27 lakh contracts which got added in PG Electro there, and the premium is up nearly 16 rupees in today's trade for PG at 500 March put. And one more put which is most active is L&T 3600 March put, where we've seen 65,000 contracts getting added. The premium there has jumped by nearly 148 rupees in today's trade, and L&T is one of the biggest losers in the index today, down nearly 280 odd rupees in today's trade. So that's the update coming in from the FNO 360 desk.
Right, okay, that's the update on the FNO picture. But just take a look at the market, and like Sajid as well was highlighting, extremely brittle. 440 points lower right now for the Nifty futures, and an acutely bad breath as well. 198 is the count, standing to the declines within the FNO pool. Let me now welcome on board Sunny Agarwal as well from SBI Cap Securities, and we've got Rajesh Palvia too from Axis Securities joining in on the show. And of course, Kunal Bothra is already with us. But Rajesh, if I could just come to you specifically on L&T. Of course, the selling today is getting quite excruciating. But do you see any near-term bottom in place at all?
Good afternoon. So we have witnessed, huge supply pressure in L&T, especially for this month itself. Stock is fallen around 20%. And looking at the breakdown on the near term as well as on the short-term chart, we believe that, yes, stock may correct further. Still, there is no sign of bottoming out. Short built-up is clearly there in the derivative data also. And looking at the structure, I think the next trajectory on the downside, we may see towards 3,300, even 3,200 in the continuation of this down move. So until the stock not able to take out about 3,600 level, any minor pullback may attract again, supply pressure, as the structure has already damaged on the near-term, short-term perspective. And clearly short built-up is there in derivative data. So I think there is another 5 to 6% correction we may see in the continuity of this downtrend.
Okay, Rajesh, what do you make of, for example, Eternal? That's the other one which has really taken a beating in trade over the last few trading sessions. What next for this one?
So Harsh, this is the sixth consecutive month for the stock where stock is making lower high-low formation, and which is a clear sign of serious liquidation is taking place in this counter. Looking at the near-term, short-term structure, there is a weakness as short built-up is there in data. Stock has already broken all its important support areas. Looking at the structure, we believe that maybe this stock may slide further towards the next swing low, which is at around 200 level. So another 5-6% correction cannot be ruled out looking at the structure. Until the stock not able to take out about 230 zone, minor pullback should be used as a shorting opportunity in the counter.
Sunny, on both of these, on an Eternal and on an LNT, what's the view? These are Nifty 50 names which have fallen quite sharply from the highs. Trying to understand whether there's a clear buying opportunity.
Yeah, I think coming first to Larsen and Toubro, I think there is an absolute panic in the stock basis that the company has got 25 to 30% exposure to the Middle East, and market is discounting that the entire order book of 25 to 30% exposure that may not get executed over the period of next 6 to 24 months, and that is what Street is penciling. I think ultimately, as the any positive development on the war front start to percolate, people will go back to an normal assumption wherein maybe there can be some delay in execution for a quarter or two. But looking at a very robust order book of closer to 4.3 trillion rupees, and within that also closer to 30% contribution is from a private sector, which clearly indicates that even private sector capex is picking up. I think post correction now valuations have even turned comfortable. Even after discounting for the correction in both the IT names which L&T holds stakes in, we feel the fair value of the business is closer to 4,200 rupees. So I think any deep currently is a good buying opportunity for a long-term investor. Coming to Eternal, there we have seen that there has been some narrative of increase in competitive intensity on quick commerce side, and that may continue to put pressure on that part of business. Food delivery business, because of this sorry for the temporary disruption in LPG supply. So maybe few eateries or few restaurants may curtail their menu, and to that extent some order flow for the food delivery business may be impacted. But having said that, now post correction, even there we feel that the risk reward is turning favorable. In fact, both this stock Eternal as well as Swiggy looks pretty attractive, as the long term growth opportunity is pretty intact. So I think again a good stock to add in a portfolio from a long term perspective.
Hi, Sunny. Can you give us a sense of what's happening in L&T? The stock is...
No, actually, Sajid, he just did. So, okay. Apologies, I threw that at you. But Kunal, let me come to you. Give us a perspective on L&T in particular, because that one on charts, I mean, 8% fall in a single day. Do you believe there's a buying opportunity here, even in the short term? Rajesh, of course, had his views, but give us yours.
Not really. I think we need to wait out for a point where the stock stabilizes. No, you don't want to catch a falling knife, because it's difficult to ascertain that at what point will this selling stop. Whether it's a point where the stock has ebbed off 1,000 points from its recent high, whether there could be a residual correction of another 4%, 5% on the downside. These are imponderables for the stock price. And in a heat of a market correction, it is always better to wait for those times when there is clarity or there is stability in the stock prices. So clarity in terms of either news flow or stability in terms of the selling for the stock. So I would probably be of the belief that I think one should wait out for a point. See, as it is, what could have happened is because of the recent sell-off in the stock prices, the markets and the stocks have become very light. So in case if there is any kind of a dose of positive news flow, it's not as if that the stock would probably go into a very strong recovery. There would be a bout of a very gradual recovery initially, and then slowly and steadily, when buyers come back again, the pace would pick up. So I think there would be ample amount of time which an investor would probably gain, if he wants to ride out this tough phase of volatility for the stock price. So I'll suggest wait out, not to buy at current levels, and maybe wait for another couple of days or maybe another week or so. Let the prices stabilize. Once we see that happening, then we can probably preempt maybe a bottom formation for the stock.
Okay, very interesting. We'll continue conversation. Sunny, I'm keen to know what you're advising your clients. On the other side of this break, we'll take that up. Stay with us. All right, at the bottom of your screen, you can see what Fitch seems to be saying. They're saying that FY26 India GDP growth at 7.5%. That's largely going to be driven by domestic demand. They're saying they're seeing some signs of India activity slowing down in Jan and Feb of this year. They're expecting growth in India to moderate between April and September, not looking pretty. And they're saying India GDP growth will slow to 6.7% in FY27, 6.5 in FY28. That's what they're penciling in. The higher oil prices, they say, can push India inflation up faster than expected. So they are penciling in a higher than consensus inflation number, or the impact of it to be higher than consensus. And they're seeing the India inflation rising to 4.5% by December of this year. So that's really the trajectory which they're seeing in terms of inflation and growth. Sajid?
You know, if you look at inflation for the last month, it was coming around 3.2%.
Yeah.
And with gas prices, which have been raised over the weekend by 60 rupees, the impact in March, for March inflation would be around 13 to 14 basis point. So far, the petrol prices and diesel prices are constant, means they've been held on, so there is no impact, but there will be an impact of the crude derivative prices coming down to the companies and others. So the first impact of the inflation will come on the WPI numbers, and then it will move on to the CPI numbers, and expectation is that this inflation will edge up towards 3.4 3.5% in the month of March. So keep a lookout for the WPI numbers as well, because as commodity prices are going to go up, the first hit or indication will come from WPI.
Okay. In fact, Goldman has also done the same thing. What they've done is they've lowered India's 2026. This is calendar year, mind you. Goldman follows the calendar year, kind of system. They've lowered the forecast from 7% earlier to 6.5%. 2026 India growth. That's meaningful in terms of the downtick there. And they've raised India's inflation forecast to 4.2% versus 3.9%. So, Fitch and Goldman Sachs calling this out.
True.
Sunny, concerned?
I think, Harsh, depends on how long these crude oil prices continue to stay remain elevated, right? I mean, there is a scenario one, if everything gets back to a normal in a span of 2-3 weeks, I think then it should not be a matter of concern. Maybe crude going back to $70-80 is something which is a sweet spot for everyone, including consumer as well as the producer. On the other hand, in case the crude continue to trade above $90 and in the band of 90 to 110 for a pretty longer period of time, 3 to 6 months, then definitely it will have a inflationary impact across the value chain, first for manufacturer and then second for the consumer. So, but having said that, luckily India has been going through a very low inflationary phase during the last 12 to 18 months, and maybe inflation within the RBI tolerance band of closer to 4.5 or 5% should not be a kind of concern which can warrant for a rate hike. Maybe rate cut is something which is now on a back burner for significantly longer period of time. So let's see how the entire crude oil prices and or for that matter energy prices scenario plays out over the period of next 2 to 4 weeks.
Sunny, how will you look at the banking stocks in the entire scenario? I mean, with many of the analysts were talking about how private banks maybe are the best bet at this point in time, but you're seeing a lot of impact coming on private bank as well.
I think yes, definitely the entire narrative has a change for worse for the entire banking as a sector, wherein because of rising crude oil prices, inflation will go up, and then there is a probability of a decline in consumption, and to that extent, credit growth may get impacted. But I think as we speak, post correction now, most of the private banks are trading at a pretty reasonable valuation. HDFC, our likes of ICICI are trading closer to 2.3 times price to book 1 year forward. So I think valuations are very comfortable in the entire private banking as a space. Yes, definitely in a scenario where there is a probability that because of the likely deterioration in the demand environment, there is a probability of spike in an NPAs that can impact to some extent public sector bank. So as we speak in a current scenario where there is an expectation that inflation may go up, private banks appears to be a clear winner. On public sector bank, I think the valuation there are again pretty reasonable, closer to 1 time price to book 1 year forward. So within public sector bank, what we feel is that the larger well-diversified public sector banks like Bank of Baroda or Canara Bank, there the impact can not be much in case there is some deterioration in the credit quality going forward. So I think if someone want to take an exposure to the bank, a mix of private as well as public sector bank is the right way, or other way to bet, or other way to ride this rally through ETFs which are focusing on banking as an index.
Interesting. I wonder, Rajesh, whether you have a view with regard to the move on Zydus Wellness, because that stock has done very well in trade on a day like this. Very strong volume-led kind of move. But give us a sense of what this means and what levels will you look out for?
So stock was in corrective mode. Yes, today's spike has given the stock to take out its a 20-day moving average supply zone, but still stock not able to cross 50-day supply zone, which is at around 420, 425 zone. Though near-term structure is still on the weaker side, series of low top, lower bottom formation is there. Stock attempted to recover from the lower trajectory, but still I think 430 level needs to cross. Then we could see some stable buying action, and then possibly stock may exhibit some further more upside. But till the time stock not able to take out 430, I think looking at the market scenario and condition, I think those who have bought at lower level can try to book profit around 415.20 zone.
Okay, now in terms of the carnage itself, Indian markets have taken a hit since the US-Iran war, of course. That's since the 28th of February. The Nifty and the Sensex are actually down around 8% odd, while the Bank Nifty has fallen more than 11%. Auto, PSU banks are amongst the worst hit sectors. Investors price in higher crude prices, of course, and global economic risks. Meanwhile, Brent crude has surged about 40%, highlighting how the conflict is reshaping global markets and asset performance. Rabinder joins in with a roundup.
Well, since after the Middle East conflict, all major world market is under pressure. If we talk about the Nifty from Indian market, Nifty index was down around 8% since this war and of the Middle East conflict. And index also touched a 11-month low intraday this week. And on a weekly basis, index is down more than 5% to register a biggest weekly fall since June 2022. And Nifty on a monthly basis also registered a biggest monthly loss since COVID-19, and 45 out of the 50 constituents of the Nifty 50 index were in red, and BSE listed companies eroded a market cap of rupees around 33 lakh crore since after the this Middle East conflict. And auto index contribute most to Nifty's decline, with Tata Motor passenger vehicle, Eicher Motor and L&T were the top losers of the Nifty index since the war started. And on the gainer front, Coal India, Sun Pharma were the top, followed by NTPC were the top gainers, and Coal India has delivered a return of 8%, which is followed by Sun Pharma with 4%, NTPC with 1%. And if we talk about the Nifty Bank Index, the Nifty Bank Index too down more than 11% since the Middle East war, and on a monthly basis, index registered biggest monthly fall since COVID-19. And Nifty Bank RSI has fallen to lowest level of COVID-19, which means index is trading in oversold zone, and both the broader indices Nifty Mid Cap and Nifty Small Cap too under pressure, and both indices has also touched a 10-month low intraday. And if we talk about the sector specific, then all major sector indices were in red since the war started, with Nifty Auto were the top losers, down over 14% since this war, and and which is followed by Nifty PSU Bank, Nifty Realty, Nifty Metal, Nifty FMCG, and Nifty IT. Nifty IT is down more than 5% since this war, and Nifty Auto was a top sector losers, down over 14% after the war, and this week also auto index is down 10 to 11% to register a biggest weekly loss since COVID-19, and all the constituents of the index are in red, and auto sector were massive under pressure on the back of the gas supply disruption. If we talk about the losers, then Ashok Leyland, Tata Motor Passenger Vehicle, Bosch, Eicher Motor, and Maruti Suzuki were the top losers, which is down around 15 to 19%. And if we compare Nifty 50 index with the other asset classes, then in USD term, Nifty index is down more than 9.5%. Gold is down 4%. Brent crude, which is the commodity, is down more than 40, which is up more than 40% since the war started, and Brent crude touched a level of around $147 per barrel after the closure of the Strait of Hormuz. And lastly, if we talk about the Indian indices with the other world major indices, then Kospi is down 12%, Nikkei 8.5%, followed by Nifty 8%, CAC, Dow Jones, and Nasdaq down 1.6 to 8%.
Okay, thank you so much for that, Ravinder. And with that, we're very, very close to market close. Just a couple of minutes to go. Kunal, Rajesh, as well as Sunny, thank you so much for joining us this afternoon, giving us that perspective. We'll let you go very quickly on to what are the closing trades that are playing out, and how have we done today on a day like this. Clear pressure. We've got, if I were to just kind of sum it up, except for maybe barring 12 stocks, we've got the balance 38 stocks which are more than 10% lower from their 52-week highs on the Nifty 50 index. Some of those counters are Tata Motors PV is down 50. Oh, okay. Tata Motors PV may not count, but Trent 44% down, Eternal 41% down, TCS, Interglobe 30 to 35% down. So you've seen some real carnage, but the moves today also have been quite strong. When you're looking at the moves today, the Nifty itself, in terms of the breadth, extremely weak. You had around 47 counters trading in the red to just about 3 counters trading and closing in the green. The advanced decline, even among broader markets, was not pretty at all. The advanced decline is 1:9 on the overall market, and that's looking really feeble in that sense. 2% lower on the Nifty 50 index. We're closing very close to the day's lows. The Nifty small cap as well as the Nifty mid cap indices closing down over 2.6% in trade today. There you go. Those are your sectors. 5% lower on the Nifty metal index, as you can see. But outside of that, autos, another day where autos have been under tremendous pressure. 3.5% lower. BSU banks down nearly 4%. Defense down nearly 4%. Of course, metals down nearly 5%. 2.5% lower for the banking index. Outside of that, oil and gas down over 2%. Fin Nifty down over 2%. 2% down even on the energy index, which has been surprisingly resilient. Everything outside of FMCG, which is down 0.5%, is badgered out of shape, frankly. And the realty index is down just 1.25%. So there's some bit of outperformance that realty has pulled out. So has the Nifty IT index. Even that one has pulled out an outperformance, which has been the case. There has been some divergence between the Nifty as well as the Nifty IT index. But with that, we'll wrap for the day as well as for the week. It's been a very tough week, frankly. There's been plenty of seesaw in terms of the way the Nifty has moved, but we've closed dangerously low. In terms of the level, 23,170 is what we've closed at.
Yes, and if you look at the options market, you're going to see that for the next week, the puts are active for 22,300 as well. So there is a lower put protection which has been done deep out of the money one, which is getting built as we speak.
Okay, so I mean, fresh levels is what we'll be exposed to very likely next week. Completely out of time on this edition of Closing Trades. Plenty of action to follow. We've got a couple of special shows coming your way, given the kind of week we've had. What should one do starting Monday morning, and what's the kind of carnage that we've seen? Just kind of contextualizing all of that. Stay with us here on ET Now. Plenty to follow.